Chair and Senator Cochran for calling this important hearing, and I want to thank our panelists here for hanging around and giving us the opportunity to continue to ask questions. I just, as we talk about reauthorization of the CFTC, I think it's important to remember that we've got to do this in an intelligent way, make sure that we, as we increase customer protection and build confidence in the financial system, that's something that's going to encourage producers and firms to better manage their risk and provide the necessary liquidity that the market needs to function freely. But we also have to remember that we're operating in an international global economy, and the decisions that we make don't happen in a vacuum, and that any additional regulatory burden we place on firms here in the United States are going to impact the competitiveness of these firms in the global marketplace. So I hope we can strike a balance between managing risk, inspiring confidence, and allowing the market to function without overly burdensome regulations. And so I appreciate those of you who are here today giving us some insights about how best to do that. I wanted to ask a question of Mr. Cooper. In the last Congress, I sponsored legislation which modified and updated securities regulations to help promote greater capital formation and improve transparency in the marketplace. I was pleased that the language was included in the Bipartisan Jobs Act, which was signed into law by President Obama. In your testimony, you have suggested that some of the provisions in the Jobs Act, which directed the Securities and Exchange Commission to amend securities regulations governing private placements, should be extended to cover commodity pool operators as well. And I'm wondering if you can explain why this is needed and what the implications are if the CFTC does not amend its rules to be consistent with the Jobs Act or the SEC regulations.
Thank you, Senator Thune. I want to thank you for your leadership as well on the Jobs Act, a tremendous piece of legislation designed, in fact, and hopefully will result in greater capital formation opportunities. We've talked a lot about consistency and harmonization today in the cross-border context. This is a perfect example where we need consistency and harmonization between the CFTC and the SEC on this particular provision. If the CFTC were not to amend its rules to make complementary changes to permit private placements, essentially, it would thwart the very purposes in our industry that the provisions that were part of the Jobs Act were intended to promote. Because, in fact, many of our members, the vast majority, are now duly registered. So not being able to participate in the broader general solicitation of private placements would, in fact, undermine the very purposes that the Jobs Act was intended to.
Yeah, thank you. I want to take just a moment to take advantage of that we've got a wide range of expertise and diversity of opinions on today's panel. Mr. Kelleher, you have advocated user fee funding for expanded regulation by the CFTC on almost all fronts, high-frequency trading, physical commodity holdings, not to mention to help cover the costs of staffing and technology, whereas others have made the case that additional fees would increase the cost of hedging. An increase in the cost of hedging will then ultimately increase the cost of goods for consumers. And I'm just kind of curious to know what your response is to that assertion or that criticism.
Thank you, Senator. I wouldn't say we're advocating fees across all boards for all, across all products, all markets, for all things. I think you have to find out that which fees are appropriate to be assessed on given the essential mandate and the funding needs of the CFTC. It's into the advantage of all the member participants in the markets, the investors, and the system that the CFTC have adequate funding that on the technology side and the personnel side. So when we look at it, we say, well, if you look at, you've got, and I can't remember what the numbers are exactly. I don't think Terry and I are going to agree on this. I mean, we're not talking India about 1%. We're talking about probably fractions of a penny per contract. But, you know, if you took 25 CBO week contracts and you had half a cent per contract, you're talking about a 12-cent addition. If you took a larger size lot of 25,000 contracts, which would be a big trade, about $70 million worth of corn, you're talking $125 on $70 million worth of contracts if it was a half a cent. And if you actually look at the numbers and then you apply it to the numbers, now everybody can disagree or have different views of what gets carved out for liquidity purposes and otherwise. You're talking about probably a very small fraction of a penny per contract. It would be so de minimis actually to end users and market participants that it's unlikely to have any effect at all. But where it has the most effect is we have a CFTC with a huge vital mandate that gets funded at a level that can service the market participants who have to register, get SDRs. You look at the information flowing in that can't be handled now. That's in the interest of everybody, including everybody at this table. So when I'm not trying to get a huge fee. I'm not trying to get more than a penny that's necessary. I think any fee should be as low as humanly possible and done in a targeted, sensible way so it doesn't impact liquidity and reduces the impact on all market participants, but generates enough revenue for the CFTC to get its vital job done, which everybody needs to have done.
Okay. Mr. Duffy.
Senator Thune, I think what's important when we're doing mathematics here, in order to get to the $315 million to fund the agency, you need to charge 5 cents per contract at the CME Group. That is a 100% increase on our liquidity providers or our average daily volume. There is no question anybody that has a 100% increase in doing their business that they have to change the way they're going to do their business. And the way they're going to change it is they're going to do less activity and widen the spread, which will cause the consumers and the taxpayers and the government more, especially when you're trying to auction off U.S. government debt, and the only place they have to go to do the layoff is at the Chicago Board of Trade, which we own. And because our markets are so deep and liquid, the government can auction off debt all day long to our participants, and they hedge it in the futures market. If that bid offer goes up, the cost to the taxpayer will go up right along with it. It will cost billions of dollars, sir. Billions.
With all due respect, I think, and correct me if I'm wrong, Terry, but you're only talking about the futures market. The jurisdiction of the CFTC will now include the swaps market. So if you take the total market, whatever the notional amount is, whatever you want to argue, you're looking at a market that's 6 times the size or more of the futures market.
But there's only 2,000 transactions a day, Senator Thune, that happen today in the over-the-counter opaque futures market, not in the futures, in the over-the-counter market. So even though it's 400 trillion notional, there's only 2,000 transactions a day. There's 20 million in the listed derivatives markets today.
Okay. Madam Chair, I thank you. That was a good discussion. And I know you have a second panel you're waiting to get up here, so thank you very much for your indulgence, and I'll yield back my time. Thanks.
Thank you very much. That was a good discussion. Thank you again for your patience in waiting.